Greetings everybody, and this is Chapter 4, Video 1. We're going to talk about the individual tax formula. Let's hit it. Greetings everybody and welcome back to class. And so in this video we're going to talk about the tax formula and use it to discuss how we're going to calculate a taxpayer's taxes due or a refund. Obviously we like refunds. Refunds are always nice. Massive refunds, probably not so much. Massive refunds are usually because somebody over withheld, unless it's a situation where maybe they got an unexpected credit or something like that. But we always like to get a little bit of a refund as opposed to taxes due, and really large taxes due, even worse. All right, so the way that the formula is going to work out here, if you think about it, it's a big income statement, okay? Now, when we take a look at an income statement for a company, we have, revenues, minus, cost of goods sold gets us gross profit, minus operating expenses gets us net income from operations, minus other expenses, yada, 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 so on and so forth. Okay, so that's kind of how that works out. On a 1040, it's pretty much the same way. So what you're going to have is that you're going to have your gross income written at the top of the form. Later on in the form, you're going to have some deductions that are going to get you to AGI, and that's going to be the deductions for AGI, as they like to call it. I prefer calling this above the line deductions because for AGI and from AGI, just a little too difficult and a little too confusing for me. Test bank questions might use for AGI, from AGI, so you still need to know it. But usually when I speak to clients about this, I don't say, hey, that's a deduction for AGI or from AGI. I usually say that's a deduction above the line or below the line. And so that kind of helps keep it clear in my mind. And so again, your gross income minus your deductions for AGI or above the line deductions are going to get you to your adjusted gross income. Adjusted gross income minus your itemized deductions or your standard deduction, whichever is greater. And we're going to talk about that really in detail in Chapter 6, so I'm not going to get too much into the weeds here. That's going to get you down to a line that's going to allow you to take a deduction for qualified business income deduction. That's going to be hit a lot in Chapter 9. Probably not testable as much on this exam coming up as it would be testable for the Chapter 9 exam where we talk about small businesses. And that's because, small businesses, partnerships, QBID is a major deal. And when I say QBID, I mean qualified business income deduction. That takes QBI for a deduction. And that's going to get you to your taxable income. From taxable income, you are then going to have your times your tax rate. Now, when we say times tax rates, mind you, we haven't gotten into how to calculate taxes yet. As we talked about in Chapter 1, the United States works on a progressive tax system. What that means is that as your income goes up, your tax rates will go up too. But what it doesn't mean is that all of your income will be taxed at that level. So for example, actually, let me take an example here. I've got in my hot little hands from my conference room table a copy of the quick the tax charts. And, so for example, there's 7 tax rates. You've got, 10%, 12%, 22, 24%, 32, 35, and 37%. All right. Let's say, for example, married filing joint, and I have taxable income to the tune of about $500,000. In 2022, because I haven't gotten the 2023 guides yet, in 2022, 35% would generally be taxed. 35% would be the tax rate if I had $500,000 of income. Now, what that doesn't mean is that all of my $500,000 is going to be taxed at 35%. That would be painful. Okay. That's not how this works. What happens is the first, and again, I'm using 2022 numbers for this. I apologize if you're watching this in 23 or 24. But the first 20,550 was taxed at 10%, and then the next amount to get you up to 83,550 was taxed at 12%, and then the next amount that's at 150 is taxed at 22%. You see what I'm saying? So the lower amounts of your income is still going to be taxed at those lower rates, and that's going to afford you a blended rate. Now we talked about what that blended rate is called. It would be, your not your marginal tax rate, but it would be your average tax rate or your effective tax rate, depending on whether we're taking that in comparison to taxable income or if we're taking it in comparison to total income. Okay. So those rates are very important, but a very good example when we have this on a test. When I used to write my own test, one of the test questions I used to love asking was, you're at a party and somebody's had a little too much to drink, and they say, I hate shopping off 35% of my income to the federal government. Explain why that person's right or wrong. And of course, the person's wrong because 35% is not going to the federal government. What's happening is their overall blended rate, i.e. their effective tax rate, more likely than not is in the 20% range. But they don't know that because nobody tells them that rate. They always tell them the marginal rate. And so that's what ends up happening there. Anyways, that could get us down a rabbit hole. I don't want to get too much into that. But you have your, like I said, you get times your tax rates, gets you your tax liability. Now you're going to have other taxes. So wait a minute, what other taxes? What other taxes can we put on 1040? Well, you might have self-employment tax. You might have additional Medicare tax. You may have the net investment income tax. There are other taxes that might be calculated that are going to be thrown onto here that you're going to have to take into account when you are figuring out what your overall tax rates are. Okay, that's going to get you your total tax, and then you're going to subtract credits. Credits are really talked about in Chapter 8 to a varying degree. We don't hit the topic as hard as I wish we could in this course. And by the way, the videos for Chapter 8 are all optional. And so if you want to watch those videos, feel free to do so. But we do talk about some tax credits and some of the tax in the Chapter 8 videos. Then we minus prepayments. What's a prepayment? Who would be dumb enough to prepay their taxes? Well, actually, every one of us does. Okay. Every one of us prepays their taxes. It's called withholding. Okay, I get a paycheck from George Mason. They take a little bit of my salary out of the paycheck, and they hand it off to Uncle Sam and say, this is a prepayment for Mr. Matthews for his tax liability for next year. And that's going to get us to our taxes due or a refund. All right. Now, like we talked about, individuals are going to report taxable income to the IRS on 1040. Tax law uses an all-inclusive income concept. What the world does that mean? All right. Basically, what it means is it's income unless we say otherwise. Okay. And if you actually look at it, Code Section 61 is actually the income that really says this. That basically, taxable income is from all sources derived, unless we tell you otherwise. And that's why we say, it's kind of, we say the all-inclusive income concept. I've heard of some people call it the exception concept, which basically means, look, if you get any money from anything that you do, that technically is income until we tell you otherwise. Okay. What's an example of something that most people don't think is income that technically is income? Well, have you ever sold anything on eBay before? In fact, one of the big controversies that's been happening with the IRS, and I've been opining on this religiously on LinkedIn every minute I get. The IRS is not, in my personal opinion, and again, this is my opinion, not GMU's opinion, they're not fully ready for implementation of what they want to do with this. What their concerns are with the IRS with the 1099K requirement, and by the way, you can look that up, what a 1099K is. Their concern with the 1099K requirement is People are going on eBay and actually engaging in business activities, or they're going, they're doing, they're renting their property out through third-party websites, and what's happening is a lot of that income doesn't go reported, and as a result of which it doesn't show up on a tax return. The IRS can't audit it. So I kind of understand why the IRS wants to do this, but here's the problem. Say, for example, I have, we'll say that I've got this pen right here. And we'll say that this pen, even though it's plastic and this would be impossible, was used by President George Washington himself to sign something. Pretty valuable, isn't it? And I go and I sell the pen. Okay. Now, one of the problems that you're going to run into with this is that on the 1099-K, they're going to go ahead and they're going to report that that pen gets done. And then they're going to say, look, Kevin Matthews sold this pen for $5,000, whatever it was. Now, is that income? And the answer is yes. And because it's a collectible, it would be what we call a collector's capital gain. Okay, subject to ordinary income rates up to 28%. Okay, and we'll talk about that in Chapter 7. But let's say, for example, it's not a pen that's of significance or value, but moreover, it's, you can't see it here, but on my desk here, I have a phone. And I decide I'm going to sell the phone. By the way, we'll say this phone doesn't belong to the business, but instead it belongs to me personally. And so I go on to eBay and I say, okay, I got this phone that I want to sell. And somebody looks at it and says, okay, yeah, I want to buy that phone. Here's Kevin, I'll pay $150 for it. By the way, it's an elaborate phone system. It's a conference room phone system, so it's really good. Clients love it, so it's good. I get that $150. Where do I put that on the tax return? And then here's the other problem that they run into, and this is where the IRS keeps, I think, banging its head. Where do I report cost basis? Now, some people would say, well, why don't you just put it on Schedule D? Well, is it really a capital asset? I don't know. I mean, it could be. I mean, it's got something that's got economic value moving forward, but as a personal... And then part of the other problem that they run into is that because it's being reported on Schedule 1099-K, most systems are not geared to translating that as when it's input into the data, the 1099-K, that it needs to go on Schedule D. So there's a lot of issues that they're running into with this. Now, here's the other thing. If I sell it, can I sell it at a loss? And the answer is no, I can't, because it's a personal use item. I can't sell personal use items for losses. Okay, so that's why they're running into a lot of this issue here. And so the IRS is trying to get this down. They're doing the best they can. God bless them. Hopefully they'll get it figured out, but they need to get that done. Anyways, slightly a little bit off topic, but you can see where this illustrates some of the issues that we have in capturing all the income that somebody has. All right. You have the income goes into two categories. It's either realized income or recognized income. Realized income, so for example, maybe I'm invested in some municipal bonds. And the municipal bonds, the funds that I have, they pay me, say I put in, $100,000 into it, and it pays me roughly about 4% in interest. So $100,000 for 4% interest, $4,000 a year. I get $4,000 handed to me every year to live off of. I realize the income, but because it's municipal bonds, we'll talk about this when we get to that area, I don't have to pay taxes on it. Therefore, it's not going to be recognized. Okay. And when we talk about recognized of the income, don't think of it so much as whether it gets reported on the tax return. I know that's what the slide says, but what recognized really means is, do we pay tax on it? Because you will report municipal bond interest on a tax return. You have to. That you have to do. There are other types of income that do not get reported on a tax return that are completely tax-free. For example, veterans benefits. As I've told my students in class, I'm a 100% disabled veteran. I get a pension every month as a result of my disability, and never shows up on a tax return. I don't tell anybody about it. And it specifically says you do not have to report this. So it's definitely realized income, definitely not recognized income, but it operates the same way as municipal bonds, but it'll be reported on the tax return for the municipal bonds, not for the veteran's disability. Okay. Okay, excluded and deferred income is not included in gross income. Excluded income will never be taxed. That's your muni bond interest, gain and sale of a personal residence under the $500,000 exclusion. But I don't know if I've done a chapter 14 video yet, but if I have, you might want to watch that if you want to learn more about the gain on the sale of a personal residence. Deferred income. So maybe I don't recognize it today, but I will recognize it in the future. Okay. Installment sales are good examples of that. Like-kind exchanges are also a good thing like that. What is an installment sale? Say I own a house here in near Tyson's, and after you've graduated and gone, and 10 years later you come back to me and now we're friends, and you say, hey, I want to move to Tyson's, and I'm like, yeah, I'm getting old and tired. I don't want to do this anymore. I'm moving to another country. I want to sell my house. And house is completely paid off. And you say, okay, I can't go to the bank and get a loan because maybe I had some issues in the past, blah, blah, blah. But I'm like, dude, I know you. You're not going to run away from me on this. Now, of course, we're still going to sign legal contracts. We're still going to do everything. So I still have recourse in case something goes wrong. But for the most part, I might trust you more than a bank does. And I say, look, my house right now is valued at $1 million. You don't have $1 million. I'm going to sell it to you where you're going to pay me $10,000 not $10,000 a month. I would say, maybe $4,000 a month or $6,000 a month. We'd work out whatever the terms are for X number of years. And so what happens is, because I'm not getting that cash until you pay me money, I don't have to recognize capital gain on that until I receive cash, because I'm a cash basis taxpayer. That's how an installment sale works. Like-kind exchange, you have a house and I have a house. And I like your house, you like my house, and I want to get rid of my house, you want to get rid of your house. So we agree that we're going to swap houses. What effectively, economically speaking, has happened. I still have a house, right? You still have a house. Maybe it's in a better neighborhood. Maybe it's in a worse neighborhood. I don't know. But the like-kind exchanges, which only applies to rent to real estate, and it has to be a business use real estate, can't be for personal use. Basically, what ends up happening is, with the like-kind exchanges, what we've done is we've just swapped things for each other. Okay, and they'll get reported. And later on, now what does it mean by deferred income? Well, think of it this way. If I swap my house for your house and you swap your house for my house, and then 6 years later you turn around and sell that house that you just swapped out, you're going to report the gain at that time. Okay? But again, we're still going to report it on the tax return, but we will not recognize, key term, recognize that income for tax purposes. All right. Character of the income or loss. That's going to determine what kind of rate's going to get applied to it. You're going to determine your rates applicable to the income or loss in the current year. So, for example, if I go to work and I work at George Mason, I get a paycheck. What kind of income is that? It's ordinary income. It's ordinary active income, because I'm actively working in order to produce it. Instead of that, I have a house. I rent the house out. I get rent from that. That's going to be ordinary passive income. If you want to understand what the difference between active, passive, and portfolio income, watch the video on the 3 pails of income. I do a very good deep dive into that in order to be able to figure that out better. Okay? So, so we're going to determine the tax rate. Again, if it's tax exempt, there's no tax. Tax deferred, no tax current year. current year tax rate will be 0, but in the future could be as high as 37%, depending on the type of income we're talking about. Ordinary rates are going to be from the rate schedule. So when you take a look at your, and I'll see if I can get this set up here. This right here, you can't probably see it very clearly, but this right here is your tax table. Basically, what's going to happen is if you have any income that is ordinary in nature, you're going to pull it off this tax table. Qualified dividends, and what it should also say up there is capital gains also, are taxed either 0, 15, or 20% depending on the income level. And the way it works out is if your marginal rate is 10 or 12%, you're going to pay 0% on the capital gains rate. If your income marginal tax rate is 37%, you're going to pay 20%. And if it's any other rate, you're going to pay 15%. That's how that works. It used to be a testable question. I haven't seen anybody who's written a question good enough for me to use, so I haven't done that quite yet. Capital gain or loss, depending on whether it's short-term or long-term. Short-term means more than 1 year. More than 1 year. Not 1 year, more than 1 year. If it's 1 year or less, it is short-term. So if I buy a stock today, immediately 1 year afterwards sell it, it's going to be at a short-term gain or loss. Okay. Now what happens is, and again, I really recommend that you watch that 3 pails of income video. I go into this a little bit more in detail, but basically what happens is, like I said, you've got active, passive, and portfolio income. Taking losses from passive and portfolio and applying it to active income is a very difficult and regulated process. Okay, so so if I have losses from, say, my rental real estate here, and I'm a doctor who makes $400,000 a year, I can't take any of my losses against my active income. They're suspended until I either have more passive income or I sell the property. On the other hand, with portfolio, what ends up happening is that you're going to subtract you're going to net the gains and losses. And if you have a net loss, you're going to take up to $3,000 of that net loss and put that on the active portion of the tax return. And then what's going to happen is that anything that's left over is going to carry forward indefinitely. Okay. Now, mind you, and we'll talk about this more in Chapter 7, but that $3,000 limitation is only taking it from the portfolio pail to the active pail. You can take, if I have $1 million of capital gains and I have $1.2 million of capital losses, I can net those two together very easily. I don't have to limit it to $3,000. Okay, so don't get confused like that. A lot of times clients will do that. Capital assets are basically any asset except for accounts receivable, inventory, and assets used in a trade or business, including supplies. Why? Well, the first two are because those are assets that are going to convert into ordinary income in a relatively short period of time. What they don't want you to do is say, oh, I'm going to get hit with this massive gain if I don't do that, and then I'm going to go ahead and I'm just going to dispose of all this stuff. Don't want to do that. Assets used in a trade or business, including supplies. That basically is like, for example, and they give the example of supplies. So at an accounting firm like this one here, paper is a supply. Okay, you use paper, the supply of paper in order to be able to run tax returns, take client notes, whatever. And so what happens is they don't want you to take those supplies, go ahead and sell them, and try to take capital gains or capital losses in order to be able to offset things. And actually, where they're really concerned with this, you'd be surprised. On the individual side, they're not as worried about the conversion of ordinary to capital for supplies. Really, they're concerned on the corporate side. And the reason why is because corporate capital losses have a very, very quick expiration time frame. I think it's back 3, forward 5. And so, if you don't have any capital gains in order to be able to use those losses, the losses get lost. And so that's where they kind of get a little bit more concerned about that. Capital gains and losses, basically the net of short-term capital gains and losses. Again, short-term capital losses are generally taxed at 0 to 15 or 20%. I'm sorry, net. Let me rephrase that. Net capital gains in excess of net short-term losses are generally taxed at 0, 15, 20%. Okay, we've already talked about what those rates are. Short terms are always taxed at ordinary rates. And the net capital loss, again, that $3,000 that you can take from the active payable from the portfolio payable to the active payable, that's been set in stone for years and probably won't change anytime soon. Okay. That $3,000 has been around ever since I've started doing taxes, so I would not expect that to change. Deductions for AGI, those are going to be, like I said, your above the line deductions. Very common ones are going to be your alimony, your rent and royalty expenses, and contributions to qualified retirement accounts. I know they're saying rent and royalty and rent and royalty expenses. I don't really call that a deduction for AGI, and here's why. Rent and royalty expenses are going to go on Schedule E, and the only thing that's going to get reported on the tax return, on the return itself, the 1040 itself, is the net. Okay, so you're not really going to see. I mean, they are above the line deductions. They do reduce net royalty, rent and royalty income. But when I think of above the line deductions, I'm thinking anything that's on Schedule 1. Okay, and alimony pre-2019 divorces and contributions to qualified retirement accounts, those are on Schedule 1. And I would say that's a pretty good example of that. Deductions from AGI, that's going to be your below the line deductions. You'll take either the greater of the standard deduction, itemized deduction. By the way, I didn't know this till probably about 5 or 10. It's actually probably more like 7 years ago. Only 18% of Americans itemize their tax returns. Most people do the standard deduction just because it makes sense. And generally speaking, you're not going to usually itemize deductions either unless you have significant mortgage interest or you have state and local tax that you pay. But the state and local tax that you pay is subject to a $10,000 limit. We'll talk about that in Chapter 6. Don't worry about it so much right now. Then there will be a deduction for QBID. Again, it's going to be your qualified business income times 20%. Generally, that is not an itemized deduction. That could be a trick question on an exam. Okay. All right. Individual, standard deduction rates for 2023. It's getting up there. I would say that year of inflation really kind of killed this. It's getting to the point where, first $30,000 of income is pretty much going to be tax exempt here very soon. And I would expect that to have some interesting ramifications. Qualifying surviving spouse is $20,800. That's actually a new thing. I actually just learned that. But basically, the qualifying surviving spouse having a reduced tax formula, standard deduction is actually kind of it's new. Used to be in the past that qualifying surviving spouse actually just filed the married filing joint rates. Okay. Married filing separately, you're going to have $13,850. If you take that $27,700 divided by 2, that's where they get that number from. Head of household is going to be $20,800. Single is $13,850, and so on and so forth. Okay, we'll talk about this more in Chapter 6. Don't worry so much about it right now. Tax calculation is progressive rates from 10 to 37%. We've already talked about that. Don't have to worry about it anymore. Some items are at preferential rates. Again, capital gains, qualified dividends. There's the tax on these items is calculated separately from the income tax. Now, you might say, well, how do they do that? What will happen is on the tax return itself, most tax return software has its own tax generation form. And and if you take a look at one, it helps you kind of what I call, follow the finger as you're trying to say, okay, this income reports this, that's taxed at this percent. This income falls this, that's taxed at this percent, and so on and so forth. And so it'll walk you through it. Okay. Other taxes include AMT, self-employment tax, 3.8% on net investment income tax, and then also your additional Medicare tax. Okay. Tax credits will reduce your liability dollar for dollar. Probably the most common one you'll run into in this industry is a child tax credit. For every kid that you've got under age 18, it's $2,000, pardon me. And then it's $500 for qualifying dependents who do not meet the requirements for the $2,000 credit. Right now, if you are a dependent of your parents while you're here at college, you are saving them $500 on their taxes. Okay. Now, you can talk to me about whether that's a good idea or not, and whether that's appropriate or not. And I've had students who have asked me for that, and I've ended up saving them some money. But in that case, we would need to talk offline. But the fact of the matter is that that's how the tax credits rules work. Okay. Tax prepayments, again, most of this is going to come from withholding. You could be required to do estimated tax payments if, say, for example, you're a partner, have self-employment income or whatever. We'll talk a little bit more about that later on. But the fact of the matter is, withholding does happen. It will actually reduce your tax liability on the tax form. And then if there's an excess of that, you will have a refund. And if there's less than an excess of that, you will owe money. And that's not where you want to be. Well, folks, that's it. I want to say thank you very much for watching this video, and I look forward to seeing you guys in class.